Hello, this is Ken Segal. I'm a partner with LGA in Woburn, and I manage the firm's business advisory and investment banking practices. Today, I have the immense pleasure of talking with my friend and colleague, Jeff Rolke with GoldCoast Mortgage. How are you today, Jeff?
Doing great, Ken. Thanks for having me.
Wonderful. Jeff is my sensei in all things real estate and mortgage related. So it's really going to be a fun session here. So I've never sworn in any of these interviews before, but Jeff, what the hell is going on with the markets and rates?
Rates are going up overall. Last few weeks they've come down, so it's been we're in kind of the eye of a storm right now. So there's inflation, there's rates being raised at the federal level to curb inflation, and mortgage interest rates are a product of the stock market. So the 10-year bond is kind of our sounding device for what's going to happen on a day-to-day. And at the beginning of the pandemic, when the 10-year bond crashed, the mortgage rates detached from that, but now they seem to be pretty well synced back up with it. So the bond got some relief over the last few weeks, and mortgage rates did too. So we've we started this year in the 2s and 3s. We've seen 6, and we're back to starting with a 4, maybe at a low 5 right now. And it's pretty day to day.
Yeah, from a consumer perspective, it's interesting because, we're probably at a 30-year low with respect to rates as opposed to a 40-year low we were a few months ago. Mm-hmm. How do you keep people's mind in perspective with that rates are still at historic lows, albeit higher than they have been?
Yeah, so I mean, most people who maybe rode out the pandemic or have already owned a house, they've had a mortgage with a 6 or a 7 on it. So they're that's realistic to them. It stings a little that the housing market is substantially higher. So that 5% is now on, $500,000 or $700,000 instead of $300,000 or $400,000. But it's the focus is on what you can control, and the stock market is not something you can control. So rates will be what they are. We try to focus our clients on good credit habits. We try to focus our clients on having a plan for their down payment so that they can get the best rates available. Your credit score is really under your control. What rates do day to day is not. So, the people that get stung really are maybe people that got pre-approved last November, and same house now is $500 a month more. And the decision isn't, are we going to buy it at this rate? It's, are we going to buy this house at this monthly payment? Will we pay that much to live there? And if yes, then move forward.
So I guess from a risk perspective, if someone falls in love with a house, but they can't afford it, they're concerned about the rising rates, and they say, well, the only way we can get in this house is if we take a variable rate. How do you guide them?
Well, there's a few factors there. One, at a lot of the lenders right now, the variable rate is higher than the fixed. So I ran one on Monday for a woman, and the 10-year ARM was 5.3 and the 30-year fixed was 4.9, both paying 0 points. So it's easy at this point. But just given there's no publishing anywhere that says rates are going to start going down in the next 7 or 5 or 10 years. So you got to know what your payment's going to be, and if rates go up, you're going to sleep well on a fix, and if rates go down, I'll call you. But if you're on an ARM and rates go up, I'll start getting, when should we refinance that? And I can't time the market, and I can't really even answer that question. So
risk though, because they do, even though in a normal circumstance where the floating rates are less, you stress that when you underwrite it to say if floating rates at the ARM today is 4%, you're not underwriting at 4%, are you?
No, you're generally underwriting 5 or 6% higher than that. So you need to qualify at 10% to get a 5% ARM. And that's because, let's say you have a 10-year ARM at payment 121. If the market, current market at that time dictates, the rate will go to 10% or 11% in one payment. So you can undo all of your savings from that adjustable rate compared to the fixed in literally one payment. And then that will continue until you can get out of that. And the question is then, where are fixed rates at that point? They're obviously going to be substantially higher too. So it's, you know, purchasing a house, you got to plan your exit from the house, or you got to, you know, be prepared to stay. And so the fixed rate prepares you to stay. And if you sell, no matter what mortgage you have, it gets paid off. So that's good. But if you do stay, and everyone, you know, people might say, well, I'm only going to be there for 7 years. But, you know, my wife and I said that, and we've been in our place for 11. So, you know, I can speak from experience. You may stay longer than you expect. And, you know, just I've never written an adjustable rate loan in my career. So, you know, I strongly believe in the fixed rate for people in their homes.
Given where prices are right now, there's conventional wisdom that says that the market's slowing a bit due to the higher rates. There may be some more product on the market. That may suggest a correction in prices. Do you necessarily agree with that?
Yes. And it depends on like you know, there's no like finite definition of correction, you know, for the real estate market. So a correction around here may just be deals become more civilized, right? Like you could make a asking price offer and get it accepted. Where a correction elsewhere in the country may be houses going underwater. So prices could go a little bit lower. Like people could temporarily go underwater that paid the absolute most for their house. But, you know, from my perspective, I still have buyers backed up, waiting to find a house. When rates went up, a lot of people just kind of went to the sideline to see what happens. And as things seem to be settling down a little bit, you know, they may come back to the table because houses are still getting put on the market and they're still getting purchased. So.
No, that's interesting. So I guess, how do people deal with the fact that mortgage rates are going up, rents are going up, there's still limited inventory? How do you counsel the potential home buyers that feel like they're getting squeezed at every end?
Just try to put yourself in their shoes and understand, you know, how they feel. And again, we just try to draw focus back to what you can control. So I've got no control over what a house costs right now or what the value of my house is. That's dictated by the people willing to buy it. And, you know, they can employ some strategies to maybe be a better buyer, you know, ways to take some contingencies off. Like a lot of people are using gifting to be able to close faster, and then we'll do the mortgage after the fact, and we can like do an approval for that process. You know, so if somebody's in the situation, fortunately, where maybe the family member could gift them the funds to buy the house, and then we can put the debt on the house after, they'll be able to close quicker. They're a more appealing buyer. And that's not an option for everybody, but offers are getting accepted. Our clients are buying houses. It's just still a little bit slower of a process.
No, it's interesting. From an underwriting perspective, I see a lot of young couples, in my mind, taking on a disproportionate amount of risk in the leverage they're taking in buying houses. So how much do you counsel them to say that if you can afford X, maybe given life events that are beyond your control, maybe you should probably look at 70 or 80% of X is what you should be affording, you know, for this 30-year investment?
Yeah, there's some kind of like rules of thumb out there, the rule of 28 and 32. So you don't want your mortgage debt to exceed 28% of your total household income on a monthly basis, and you don't want your total debt to exceed, you know, 32 to 33% of that. So that's going to dump your car payment and stuff on top of your mortgage. We're somewhat constrained on like counseling on that, but what the trick is to turn the mortgage into a monthly payment. So like $500,000 and $700,000 are just a lot of money. But $3,200 a month, that's an exact number. So, you know, we'll have a lot of people, we can suggest like open a savings account somewhere, and every month for 6 months, you know, throw $3,200 into that. And if you're paying $2,200 in rent, just put $1,000 into that. And now you're making your payment. Is that, you know, you're still going out to dinner when you want to, or you still having, you know, lunch when you feel like picking up lunch and buying your groceries and stuff. And if you are, and that's a comfortable number, then, you know, purchase the house you want. And if it's not, find out that way instead of by closing on something. It is easy to overextend yourself.
Yep. No, that's so true. So I guess one of the other things you hear about is you hear inflation, you hear the benchmarks and all these other numbers going on. So, tell me, so if inflation goes up, inflation goes down, does that matter when you're considering what the risk is in underwriting a mortgage for somebody? What do I
So like a conventional loan underwriting it's strictly based on what's called your ability to repay. And that is your annual income. If it's W-2, you take your salary, divide it by 12. If you're self-employed, it's a 2-year average of your filed tax returns divided by 24, right? So there's your monthly income. And you can use 50% of that towards a mortgage. That's the max on a conventional loan. There's other products that can go higher and so on. On a jumbo loan, you can only go to about 43 or 45% of that. And then your monthly debt is carved out of that 50%. So that's only debt that would appear on your credit report. So your credit card, a car lease or a car payment, your student loans, stuff like that. And then the other 50%, the presumption is that's buying groceries and putting gas in your car.
Right.
And that's the stuff that's just your day-to-day expenses. So you're going to need obviously money for that. So 50% of your income can go up to it or into it, but if you keep it at that 32%, 30%, you're going to be able to save or go on vacation or stuff like that. You want to avoid being, house poor is the term.
So like you say then, is if you peg a fixed interest rate for your mortgage, that's a fixed cost for basically the next few decades, so you don't have to worry about it. And then as a wise man once told me, inflation is tied more to what you're paying for cereal as opposed to what your mortgage is.
Yeah, precisely. So, the best mortgage indicator, like I mentioned earlier, is the 10-year bond. And just if that's tracking upwards, rates are going to track upwards. And if it's tracking downwards, rates are going to relax a little bit. So it's nice to sort of have that measuring stick back.
So crystal ball me, we're on a recorded line, so everything is absolutely verifiable. But a year from now, what do you think is going to be going on?
Geez. Rates will be higher or lower. I don't know. There's enormous forces at work trying to do both of those things, right? So our lenders are in competition with one another to earn the most business, and the solution to that is to have the superior terms available. So they're trying to keep their rates low, and then we have the Fed that's driving rates up to curb inflation and so on, and all of those things eventually shake out to what the retail client receives, and it'll just sort of be what it is at that time.
Yeah. So I think the best advice you're giving then is just don't focus on one thing, just like in anything. Listen to as many different points of view, draw your conclusions, but understand that there's not just one factor. You say, I just follow that one thing, and therefore I know what's going to happen in housing, the market, rates, everything else. Is he just
and you got to just get live quotes. So like if you're not buying a house for a year, you can get pre-approved now. You can find out how much you can afford. And somebody in my position, if rates are at 5, we're going to pre-approve you at 6.5. And that way, if rates go up to 6, you're not reorganizing your life over it.
Mm-hmm.
So we say, like, hey, here's a payment of $3,500. You can easily make that. If you find a house tomorrow, that payment's going to be $3,200. Nobody's mad. And if you're riding right at your absolute maximum and you find a house that the taxes are maybe a little bit higher or rates go up a little bit and you come out of contention, it's difficult to manage. So we try to coach people, we try to set them up for success in that way. But that doesn't future-proof anything because anything can happen. So
I love it. No, Jeff, this has been so helpful, and you and I have talked about this for a long time, and we've had a lot of happy and well-informed folks that we've sent your way. But in closing, if you can just tell us, your website and how people can find you, I really appreciate your time today.
Yeah, if you type in Gold Coast Mortgage just into your Google search, we'll pop up. And we'd love to have our reviews looked at. We're very proud of those. And then our website's got pretty in-depth information into how to strategically approach the market. We try to design it around our future client reading and getting good information. So you won't find any sales material, and you won't find anything harassing you into a phone call or anything. It'll more be information is always free. So we're happy when people reach out, and we're happy when people find what they need from us.
That's awesome. Thank you so much, my friend. I appreciate it.
Thank you, Ken. We'll see you soon.